Here's a bit of a quick explainer on Labor's Div 296 tax and why it could matter to more of us than you'd think. If your super balance is going to be over $3 million, the government wants to tax the earnings on the amount above that at a higher rate. They want to add an additional 15% tax on the earnings. Now, one of the reasons people are a bit irate about this is because it's not just the actual income like dividends, distributions, interest or rent, but it also includes the unrealised gains. So if your investments are going to go up in value, even if you don't sell them, the growth is still taxed. So here's just a very simple version of how it works and not take into account the impact of contributions. They'll check your super balance at the start of the financial year, and at the end of the financial year, it could have started at 3 million, increased to 3.5 million. So there's $500,000 increase above the $3 million cap. Then they're going to work out the taxable portion, which it's going to be a proportional percentage of those earnings based on the total end balance. So in this example, it could be about 14.3% of that 500,000, which is 71,500, which is now subject to that extra 15% of tax. So you're roughly going to end up with a extra tax bill of around 10,700, almost 11,000. So that's the first thing. Now, here's the big catch. That $3 million cap, it's not indexed, so it's not going to rise with inflation or wage growth. And as time goes on, it's going to capture more and more Aussies, especially those that are in the younger demographics. So, for example, someone in their early to mid-30s today, say you could have around 150 to 200,000 in your super already, but from a combination of contributions over your working life and average earnings from your investment strategy, your super balance could quite naturally grow to that $3 million level over 30 years by the time you're age 60 when you can access it. So you could very well find yourself caught up in this new tax net, even if you didn't think it was something applicable today. So, people are already talking about how they can minimize this for the future. Some strategies have been tossed around. They're talking about readjusting their investment strategies, their asset allocation, withdrawing funds, investing outside of the superannuation environment, such as in investment bonds. They're talking about spreading the wealth between spouses, between family members, contribution splitting. Look, all of these strategies, not everything's simple. The rules can change over time. The key is that once your super crosses that $3 million cap, the tax game is going to be changing. So you need to make sure that you're aware of it and aware of the strategies that could be possible to help minimize the impact to your position.